Sorry, I keep having some technical difficulties. I think I'm just not good here. Just give me 1 second. Alright, now I think I should be fully good. Up on YouTube, up on the virtual trading floor. Let's do it. I'm an associate member, and you guys can hear me, right? I see that no one said anything. Cool. Alright, I'm an associate member of T3 Trading Group, which is an SEC registered broker-dealer and a member of FINRA SIPC. All of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. Here's the position disclosure. I did not add anything new today. Let's talk about trading. Really big update on a percentage basis. It didn't feel like that big of an update to me, as the numbers I'm kind of seeing here. SPYs are up 2 3/4%. Qs are up 2.5%. IWM's up almost 3%. It's a massive day actually on a percentage basis. That is after this market has just been getting totally clobbered. We just came out of the worst September in 20 years, worst September since 2002. I think the S&P was down 9.5% for the month. So just a really, really bad September we came out of. And September is historically a pretty bad month to begin with. And you can see here on the daily chart, there was almost no buying the entire month. This one little rally that we had right into this this day here. Which day was this? This was the CPI number on the 13th. It gets a little confusing for me when I was on vacation. I think that was I know that was one of the big number days. I guess that was the CPI. Someone correct me if I'm wrong. But anyway, just a complete smoke show here. So interesting that we come into the first day of October. We finally get through September. We stage a little bit of a rally. Is this to get anything that we can get excited about yet? I would certainly say no. We didn't really recapture any key levels for this market. 370, I think, is a big level to recapture for the SPYs. We didn't do it. You know, even after it being almost 3% up day today, we're only back up to 367. We're only up to the 80 MA on the daily chart. If you are bullish, there's a couple things that we can point to here, and maybe that will lead to a little further upside. One is that Friday was technically a breakdown day of a bear flag, and we did not get the immediate follow through. It also hasn't failed though. The bear flag itself would only really be a total failure if we start getting above 370 on a closing basis, and that hasn't happened yet. But the fact that we had a breakdown on Friday on high volume and closed at lows but did not get follow through is something to take note of, because one of my favorite sayings in technical analysis is that from a failed move comes a fast move. So if it does become a failed breakdown from Friday, and that would be confirmed, I think, if SPYs get above 370, which we were unable to do today, then maybe we see, a much bigger upside move. I had mentioned late last week, and I still do think it's possible, that you could have a rally in the SPYs to the upper 370s or even as high as 380 and still maintain an overall bearish tilt to this market. Market should have some ebb and flow kind of naturally. So that's the technicals here. Again, a solid update to start the month. Maybe you're just attributing that to new start of the month money flow here, and by tomorrow we're back into our downtrend. That could easily be true. All we did was snap back to the 80 MA. We're now no longer extended the downside in this market, so we could be setting up for further follow through. But there is the potential of a snapback just deeper into the equilibrium zone. That's normal. And another thing that you could look at, in addition to the potential of a failed bear flag in the S&P, is I still think this relative strength in the IWM. The IWM was relatively strong Thursday, Friday, and today. And we've just so consistently seen that when the Russell starts showing relative strength, that the entire market starts holding up a lot better. When the Russell starts showing relative weakness, it has consistently been a signal that the entire market begins to break down. But even with the IWM relative strength, it didn't capture its key level either. You need the IWM to close above 170, but it pretty much got right to it. It's above the 80 MA on a closing basis. It's into its equilibrium area. So that's the big question, and that was kind of the question that Pat was saying into the close as well. Is this just day one of a bounce, and we're going to see further upside follow through, or is this Cold Smoke Brian here was just saying, is just another little bounce back to the equilibrium zone in a series of kind of bear market bounces that then lead to further price action? I don't think that we have confirmation on either of that yet. And since we don't have confirmation of it being a bigger bounce, you're probably better off assuming that it's not. You're probably better off assuming that it's not, but having your risk management in place and your game planning in place so that you are neither hurt and can potentially benefit if it actually does become a little bit of a bigger bounce. So that's how I think that we want to be thinking at this point, and I think that's how we want to be positioned at this point. So nothing to be too excited about yet. Qs are still relatively weak, not able to recapture any key levels there. That's kind of the big picture for the market. I kind of went over real briefly in the morning meeting this thought process that I'm kind of going through in my mind of how this market resolves itself with the Fed. I spent a decent amount of time thinking over the weekend about the Fed's current stance and its effect on the marketplace, and how it's really starting to have these negative reverberations globally, just with what we're seeing in the currencies, the yen, the euro, the pound, the yuan even a little bit, what we saw, and that was partially of their own doing with the fiscal policies that Great Britain is making right now. But I think that also actually has something to do with the tightening that we're seeing here in the United States also, that caused the pound to deteriorate to the degree to which it did, and then the central bank over there coming in and buying those gilts at the long end of the curve. Yeah, exactly, Mark, and that's the other side of it. So those are the two things that I'm really wondering here with the market, and that's what I was talking about in the meeting. Like on the one hand, that fear that we saw in September, in combination with what the Fed is doing right now, my biggest thing, and I think I said it a while ago now, is obviously inflation's a terrible thing, and the Fed needs to do everything they can to bring inflation down. With that said, it almost seems to me like the degree to which they lost their credibility by how much easing that they did just has them going so far in the other direction to try to get their credibility back that everybody talks about the potential of breaking something. And that could be what we're seeing. They're breaking currencies. They're breaking Great Britain. They're potentially causing defaults out of both CS and DB, though we saw some commentary on the other side of that today that maybe it's not so bad, but we saw the same thing when Lehman was going under, right? They were saying Merrill Lynch, like right up until the last day, they were saying they were in a fine position from a capitalization perspective, and then boom. So that's the big question. I mean, I am still in the camp that it's not that. Because I think that the whole world is different. One of the things I did see on the bull side of things is, like, if you look at subprime loans, I listened to some statistic last night when I was driving home, when I was listening to a podcast that basically said that, like, it was the percentage of subprime loans then versus now that are out there, and it was like 28% of loans were subprime going into the financial crisis. Now it's still less than 5%. These banks pretty much across the board have so much stricter capitalization rates and requirements now than they did then, and that's all as a result of the financial crisis. So I don't think that we're set up for a credit crisis in the same way as we were then. But I just think that the Fed needs to just be able to say that they can take a pause. They're close to being able to break stuff. They're close to being able to completely shut down this economy. And the mortgage interest rate, for sure, at 7% is one of the big things to point to. But that's also what I'm pointing to at the same time on, I think inflation has to come down at this point. You just have to give it time. Yeah, but it is, and I appreciate that comment, Mike, but how big is the auto market compared to the housing market? So absolutely, and we're already starting to see, we're already starting to see like vehicles getting repossessed and stuff like that. But it's the auto market's just so much smaller than the housing market was. So I think that more likely than a full-blown financial crisis like what we saw in 08 and 09 is just a potential like real crumbling of the economy, which that goes back to what Mike Wilson is talking about with the earnings slowdown, and that could be the next thing that really brings us down further. But the flip side is exactly, Mark, is they have to see that lumber's down 70% from its high. They have to see the degree to which all of that type of inflation is rapidly dissipating, right? Everything that's commodity related is massively dissipating. You're seeing all these stores, we just saw it most recently with that last Nike earnings report, who have too much inventory now, and they're having to basically, bring down prices to get rid of their excess inventory. The sticky portions of things are one still, related to kind of real estate, housing, and particularly rent. But rent is always such a lagging thing, right? You first need the housing market to kind of come to a little bit of a standstill because interest rates are at 7%, well before we can get to the rent numbers then falling kind of after that. Or at least stopping the continuation of the upside. And then, you still do have, obviously, wages increasing as well, but I think that should start coming down as well. My biggest point is, and I hope that the Fed sees this, that I'm sure they must see it, as a matter of fact. They're just continuing to just talk tough, and that's fine. I just think that at this point, when you raise by 75 basis points, right, this is the fastest that we've ever increased interest rates basically in modern economic history, with the exception of 1980. And the difference between 1980 and now is now that we're starting from zero. In 1980, you weren't. I just think that they should pause to see what actually happens from their actions. You increase by 75 basis points. How long does it take for that to actually flow its way through the economy? And if you keep just doing 75 and 75 and 75 and 75 and 75 without actually seeing what it does and giving it time to digest into the economy, that's when you really do potentially start to break stuff. So all of this goes back to, and this is all just chatter, right? All this kind of goes back to the stock market and seeing what our next step here is. And I think that the market is starting to look at two things. I think in one way or another, the market once again is thinking that the Fed is going to have to stop the rate increases and potentially even do an emergency cut again at some point. But is that because the system's really getting broken here, in which case we do see that massive capitulatory event? We haven't seen the capitulatory event. I know on Friday we closed on lows and volume picked up. There was that one other day that was the snap day. The only day that I feel like I actually saw, because I've seen capitulation in my trading career before, and I don't think I've really seen it this year. The only other day that I feel like I saw a little bit of capitulation was at the May 24th day. It was like for an hour on May 24th, and then it ended. Was it May 24th? Yeah, I think it was actually the beginning of this day, and you can't even see it on the daily chart at all at this point. But like, a real downside, massive capitulatory event could come in as the market really begins to break something and you get blood on the streets, for sure. I think we would like that, and that could be a really fast move down to somewhere between 320 and 335 in the SPYs. But it has to happen fast. It has to happen because people are fearful. Or the flip side is the bottom that no one wants, and that happens, right? If everyone's looking for a capitulatory event, you sometimes don't get it. And that's really what happened in June also, in May, June. Everyone wanted that capitulatory event, and it really just did not occur. And the flip side of it is market participants start saying, hey, we are reading through the veil here of the Fed. The way the dot plot is currently set isn't going to be able to follow through. And they've even said that they're not that you know, don't pay attention. Powell himself said don't pay too much attention to the dot plot. And you know, they come out and they say, they just reduce their language and say, hey, look, we've done a lot of work here. You know, we took it all the way to the 5-yard line, and let's see now what's actually able to occur based on all of the hiking that we've done. And we don't want to, you know, put the world or put the United States into something that it can't get out of on the actual downside. So let's just take a little bit of a pause here and see what it does to inflation over the course of the next 6 months. And I think the market will probably really rip on that. So those are kind of the events that I'm looking for. And then the market being a forward-looking mechanism, how does it interpret that, right? If something actually breaks here, then we start you know, totally falling apart. Or the flip side is that it looks forward, it says, hey, the Fed's going to have to pull back on the gas pedal here, and we get a snapback. And the only thing about a snapback, and the Fed, I'm sure, is being cautious on this also, is that when you couple the beginning of a snapback with market dynamics the way they are, you get a recipe that just leads to what happened here in July and August. I don't think the Fed wants that either. You know, this degree of volatility has been so insane. Because all of a sudden you got SPYs back at 430, and it's like, well, you know, how are we really combating inflation if SPYs are at 430? And that's the flip side of, you know, if the market perceives any weakness there and we begin to have the beginning of a bounce back, the amount of a short squeeze that could come off of it is just crazy. So it's just a lot of the thought process I've been kind of going through here with the market. Obviously, technicals are going to confirm what actually happens here, and that's what we want to look to. So just know your key levels. Keep it simple, stupid. Recognize the fact that we are... isn't the market ripping something that the Fed doesn't want? I don't follow the question. So like I'm saying, you know, just let the market technicals dictate it to us. You know, if we start recapturing, you know, key levels to the upside, just recognize the potential of events like what we saw in July and August to occur. Don't fight it the whole way up. As a matter of fact, make money from it. Take your levels. Take your breakout trades. Hold the positions overnight. Let that money come to you. But the flip side is recognize that we are in a downtrend. So when the short setups are there, don't be afraid to take them, and don't be afraid to hold them for follow through as well. So right now our technicals, like I'm saying, we have the potential of a false breakdown here, of a bear flag in the SPYs if we're able to recapture 370. I love the IWM leadership. I love that the semis were able to perform a little bit better today, but it is just a day one. And then, you know, the big thing is also going to be as we come into this earnings season, and honestly the earnings season even after this, just to see how these events are negatively impacting the earnings on these companies. So that's all I got for you guys on kind of a big picture. On a small picture, I was having some weird issues with Lightspeed off the open. You guys probably heard me complain about it a little bit, and I think that put a bit of a damper on some of the trading that I was actually planning on doing today. I'm trying to find my spreadsheet. But we talked about a couple of ideas today. Peloton I traded, but I just liquidated it because I was having issues with my trading software. So first of all, going back to the morning meeting today and the market, you know, we were really right about the bounce coming in, but also right when we were talking in the morning meeting about how the execution of it could be super difficult. Really would have loved to have had the gap down that we were set to have at like 6 a.m. this morning, because it would have been a day 3 gap down, and it would have been $10 extended from the ADMA and the SPYs, and that would have made just for a much easier buy. This opening price action, if you look at like the SPYs or the Qs, just very difficult. The way that we sold off for like 12 minutes, catching this bid and then rallying higher. You know, the real signals came in when we broke new highs and then broke new highs again, basically at 10 o'clock. That was your real signal to buy. Off the open, our game plan was to be patient, recognizing that it was a difficult spot because we're gapping up in a bearish market, but we felt that there was the potential for, you know, a further upside bounce today. We're talking about focusing on stocks that were, you know, potentially in play for upside action. And then we only really got the market confirmation here, I think, at maybe you can make the argument at 9:45, but I felt very iffy about it until 10. And even throughout the day, I thought that this rally was just not It felt like the market was rallying better than a lot of the stocks were. But we wanted to look at names that were in play. So, Peloton was one of the names I was looking at off the open. A very difficult open for Peloton as well, just because of what the market did. 730 was really the trigger. I tried to cheat on this with an opening feeler position. I basically got out of it after it was bouncing back for break even, just because I was having issues with my light speed. So I'd never, sized up in this on the break of 730 or anything like that. But 730 was the level. Not fantastic follow through, but if anybody was able to get this early and had it into the close, you got an okay price, and we'll see what it can do with this kind of inside and up. So that was one that was on the radar today. We had the energy stocks on the radar, but the problem with the energy stocks I felt was that the gap up was just too big. Huge gap up here. It really took 45 minutes of digestion. Honestly, even more. Probably took almost till almost 11 o'clock of digestion. Because this is what happens when the gaps are this big. You gap up this big, it needs time or price. In this case, it's a time correction. The market's moving sideways. It's building out this wedge on the 5-minute chart. And just as you're saying to yourself, all right, look at this. The ADMA finally caught up on the 5-minute chart. We can break higher here around 10:10. Well, guess what? It's 10:10. And at 10:10, 10:15, your 15-minute chart becomes more important. So we spent all this time correcting on the 5-minute just for it to then be late enough in the day where your 15-minute chart needs to correct. So then you got to wait even further. This 15-minute chart, finally catches up a lot more. And then next thing you know, it's 10:45 before you can start looking at continuation. So the energy idea today was the right idea. It was just the gap was so big that they made the execution on that really difficult. So I don't know if anybody was able to capture. I know we mentioned Apache this morning. I mentioned Exxon this morning. Some of you guys were looking at Oxy this morning. I don't know if anybody was able to make any P&L in those names, but the degree of the gap I felt made it very difficult. Pat had also brought up this SWN for a break of 640. One of the benefits on this one was that it also got upgraded. So that was an okay trade. Not a tremendous amount of follow through, a little bit of a cheaper name. Peloton we spoke about. Financials were on the radar a little bit, particularly Wells Fargo, to see if these financials could get back above 31. That's solid to me, actually. This XLF chart looks pretty good to me. XLF getting back above 31 is like the equivalent to me of the SPY getting back above 370. So we might have a little bit of leadership here from the financials. And I think that actually means it's worth keeping them on our radar. Wells Fargo was the one I particularly mentioned in the morning meeting because it got upgraded. Generally not my favorite bank, but was able to give a little follow through that $41 area that we spoke about. So I'm not sure if anyone was able to be involved in the banks today, but it was okay. FANG stocks. Yeah, so these FANG stocks were interesting. Meta did not break the key level here. That was at 140. And we wanted to see if this would show any relative strength. Traded very, very sloppy. So 140 is the key level. Google, $100 is the key level. Google did show relative strength really early. So I know that this was a focus for me and became a focus for several of you guys as well. There was a couple call outs in here. I think we called out going long versus the low. We called out the long versus the second pivot low. And we called out the long versus the third pivot low. I specifically mentioned that I did not have as much conviction off that third pivot low. But if you took any of them, they worked. And they gave you the great opportunity to kind of really follow your trailing rules higher here on the 5-minute chart if you caught it. And it closed decently well. So even though Google did not recapture the daily level, the relative strength was so notable early on today that I think some of us were able to capture it. We're looking at Apple when it was back here at this 140. Apple was relatively weak pre-market. It was relatively weak at the open, but then that switched. You can see here the Qs had a lot more ebbing and flowing, and Apple was kind of flowing up and then holding sideways, particularly around that 140. We discussed this inside 5 that came in at 1010 in this 140. It was kind of digesting back and forth. I think a couple people were buying Apple in this 140 area for the inside 5 and up continuation as the moving averages were catching up. This pullback's definitely a little bit deeper than you would like it to be at 1140, but technically never violated those lows if anybody caught it. You got a pretty good close here for Apple at 143. ADMA on Apple still at 146. So this is another one. You get a price of 140 in Apple intraday. Closes at 142.50, closes at 143. Got a $2.50 profit cushion in Apple with the ADMA all the way up at 146. This would be something I think you'd want to swing in case the market's able to give that further upside follow through, like we're talking. That there is the potential for, I'm not saying it has to happen, but there is the potential for, SPYs to snap back to 375, 380. If that happens, and you got Apple from 140, you kept it overnight, you could easily be looking at Apple back at the ADMA here and getting another, $4 worth of upside. And those are the types of trades that I personally love. You come in, and maybe this is not an A+ trade here. Heck, I would argue it's certainly not an A+ trade here. But you're able to, come in and get relatively small risk on an Apple trade here. 40 cents risk, 25 cents risk, something like that in here. And the next thing you know, it's closing well. You're swinging it. Whoops. You're swinging it, and you could have a, target here, an initial daily chart target of just a snapback to 145, 146, and get really paid off of that. So that one worked out really well. Amazon was weak early, eventually caught up. I mentioned several times, I really want to see this Amazon, clear back above 114, and then finally was able to do it through 1025. I don't think I loved that as a trade because Amazon was relatively weak today. Like if you compare your Amazon chart versus your Google chart, certainly very relatively weak. But we talked about this morning the importance of Amazon recapturing 114. Technically, that could have been a trade for you as well, and then it played some catch up and traded really well. Microsoft, oh wow, Microsoft cleared 240. So Microsoft 240 was the big level that we have discussed the last couple trading sessions in a row. Even though this closed on lows on Friday, I thought that there was some relative strength here on the last couple of trading sessions on an intraday basis, and then. 240 as a break was just really nice on Microsoft, but you wanted to have it probably even earlier than that, and this is another one just letting it kind of follow through further for you. Tesla, I totally stayed away from, like I said I was going to, though honestly there was probably a decent short trade there through 250, which was a kind of a key level that was discussed in the morning meeting. I was holding 250 as support pre-market. It just destroyed it through that level during the day today. It was one that I totally stayed away from. Netflix I also felt was very out of play today, but overall this Netflix chart I still think looks really good and really bullish, and is probably worth paying attention to. So there was some okay opportunity in some of these FANG names today. Some okay opportunity, maybe in some of the names that were in play. In the semis a little bit, I was able to do decently well with this NVIDIA that I was looking at early. But I would not characterize anything as an A+ trade today. We came in with a difficult situation, a gap up in a bearish market, but not so big of a gap up that it was a layup to the short side. So we had opening sloppy price action. We had bullish confirmation on an intraday basis, between 9:45 and 10 a.m. And that led to some okay trades for, your Google or maybe Amazon and Apple. And I personally was able to make a few bucks off of that, and I hope you guys were able to as well. So that's all I got. And I'm seeing Paul's question out of the corner of my eye, and before I get into the specifics of Paul's question, I did want to talk a little bit about risk management and just bring that up again, because I had a couple conversations with a couple traders today just about the importance of risk management and reward maximization. I think I won't go into a whole big rant today, as I do occasionally, and it's probably worth it for me to do it occasionally. But it's just worth it to certainly reemphasize a few things here based on conversations I was having with traders, and just to kind of say it just generically to everybody. You guys, at the end of the day, trading really is just a numbers game. And the numbers game, the math portion of the numbers game, is the most important part about this business. And we as a team probably spend a disproportionate amount of time focusing on technical analysis and charts and things like that, compared to how much time we spend talking about risk management and reward maximization, given its importance for success in the business. I have analyzed my own account for months and months and months over years, and analyzed hundreds of other traders' accounts. The key to this business is to keep your reward as unlimited as you possibly can, and have your downside consistently limited. It's so important. And again, it's just simple math. And every trader here should have rules that are based around this simple math. You show me a trader who should not be allowing themselves to lose more than, and I like to just use simple numbers, take these simple numbers and apply it for you. And again, we got some people here that are working with accounts that are $10,000. We got some people here who are working with accounts that are in the millions of dollars. So take these simple numbers and apply them to you, because it doesn't matter. These principles are necessary for success. But if you show me a trader who should not allow themselves to lose more than $500 in a day, and you look at that person's account and you see down days that are down 800, down 900, down 1300, I can already tell you I'm not looking at a trader who's going to make money in the business. And on the flip side of that, they need to be making up days that are a multiple of that downside day. So if that maybe that same trader is having good days, making $1,000, making $1,300, making $1,500, making $2,000, but if they're also at the same time allowing themselves just to blow past their downside limits, best case scenario, I'm looking at a break-even trader. I'm not looking at a trader that's consistently making money. Sometimes I see the opposite. It's a little bit more rare. Most of the time the issue that traders have is risk management, but sometimes I see the opposite. I see the trader who is very disciplined. They don't ever lose more than that $500. But as soon as they're making some money, as soon as they see some green on the screen, they're closing out of their positions. And I look at that trader at the end of their month, and I see, all right, really consistent, great discipline. Look at you. You never let yourself lose more than $400 or $500 in any given day. But on the upside days, I'm seeing you made $300, you made $400, you made $200, $150. As soon as you're seeing green on the screen, they're out of their positions. That's another trader who, best case scenario, is going to be a break-even trader. We're not here to be break-even traders. And that's best case scenario. That's best case scenario. You need to create rules for yourself from a money management and game planning reward maximization standpoint, where if your bad day is $500, you are disciplined and you never lose more than that $500. And if your good days come together, you are able to make $1,000, $1,500, $2,000. And many of you only have one side of the coin. You have to have both sides of the coin. There are many of you who either are consistently disciplined on the downside but aren't making the money on the upside, or they're making the money on the upside and aren't having the discipline on the downside. And it shouldn't be that hard of a fix if you put the work in, create the game plan, and then have the discipline. It shouldn't be that hard of a fix. If you're that trader who knows how to make money, some of you guys know how to make money. I see it. Like, oh boy, this guy just crushed it today, or a gal. But then, next thing you know, there's just giving it all away in one particular day. All you got to do is do the same things you're doing on the upside days, but just cut yourself off on the downside. It's not worth it. It's not worth it. I know how we all think. I'm a trader too. We think, I'm not supposed to lose more than $500. I'm down $700. But you know what? I can make that back. I know how to have $2,000 upside days. I can make that. I shouldn't stop here. I can make this back. Why would I just stop here? Trust me. Stop. Stop at 500. Never let that 500 go past 500 on the downside, and continue to do those same things on the upside. It's going to be there. That's the adjustment that you need to make. Or if you're the opposite person, you're having that good, consistent downside risk management, but the upside just isn't coming in, your problem is game planning for reward maximization. Create the game plan that can enable you to make more money. You will go broke by taking profits. You will go broke if you have good risk management, but you can only make $100 when your trades are actually right. Don't liquidate your position just because you're seeing the market move in your direction. Have a game plan that focuses on covering the risk, like we talked about, and then having the reward maximization be able to be there. Once the risk is covered, the stress is off. The stress is off your shoulders once the risk is covered. So let it go. And that's what you need to do. You need to do both. You need to have the downside risk management and then the upside reward maximization. It's the only way. I don't care what your strategy is. I don't care if you're bearish on the market. I don't care if you're bullish on the market. I don't care if you trade technicals. I don't care if you're a scalper, what your strategy is. The only way that strategy will be profitable is if it has the money management stuff that I'm actually talking about here. So just wanted to re-emphasize that for everybody because it's extremely important. Had a couple one-on-one conversations with a couple of traders today about it who are, very close to the hurdle of becoming really good profitable traders, and you're just not quite there yet. And I know it's not just the couple people that I spoke to today that are having that problem. I know there's more of you out there, so it's worth it to just kind of review here in an afternoon meeting. No problem. Now I'll go back to, I see Paul and Mark gave me a couple questions here. So from Paul, looking to make sure I have my numbers and my math right. If I'm risking $100 per trade, do you give yourself a 4-trade limit, $400 for a lockout, or is it more important to base the lockout on an average winning day? Trying to make sure I have my daily money management numbers in order. Sure, so I think that the lockout, first of all, the number that you come up with is definitely going to be a little bit more of an individual thing, kind of based on both your trading account size and where you are personally in your trading career. Generally, I think that maximum daily loss number is probably going to be more based on your account size than anything else. And then how many trades that you can give yourself. So, if you're a newer trader, I do tend to recommend that you risk an average of $100 per trade. I think it's like a great starting point. If you're risking less than that, it's difficult to ever be able to have enough stock to actually have the game plans in place for reward maximization like we're talking about. If you're risking more than that, it might not be appropriate. But for just about anybody here, even for a more entry-level type trader, even for someone who's got the smallest possible professional type account, it should be able to be appropriate for you to risk $100 a trade. And then what should your maximum loss be? $350, $400, I think is a good sweet spot. So $350, that gives you 3.5 trades. $400 gives you 4 trades. Think about it. If you're risking an average of $100 a trade and you have 4 trades that just 100% fail for you, like in a row, and now you're down $400, and I like to use 350, and that gives you 3 tries plus a little margin for error. That's kind of why I come up with that 350 number. But you could use 4 and give yourself 4 trades, and then just recognize that you might have a little slippage, a little margin for error. That 400 is 425, it's 440, whatever. But think about it, right? If whatever that is, 3 trades or 4 trades, that per trade amount adds up to your maximum daily loss. If you put 3 trades on in a row or 4 trades on in a row and all of them just straight fail, you got to recognize that you're just not seeing the market right that day. You should want to stop. You should want to stop. We all have those days. Believe me. I have them all the time, and I have to do it publicly when I'm wrong, right? So there is nothing wrong with being wrong, because it will happen to everybody. But recognize, hey, I just did 3 trades this morning, 4 trades this morning, and every single one of them 100% failed. I couldn't even get my risk covered. Clearly, you're just not seeing the market right that day. So stop trading for the rest of the day. That's fine. It's totally fine to do that. And I'm not saying, whatever, go, I don't know, fly a kite. Spend the rest of your day self-analyzing, analyzing the market, doing additional research, working on your game plans. There's plenty of stuff that we can all work on to improve as traders. But you gotta, create that number for yourself and then stop. So Paul, 4 trades, $100 each, $400, that works. Or, 3 trades, $100 each, and giving yourself a little room for slippage there, that works also. Mark's saying that he has a rule, perfect. He mainly focuses on scalping with three trades, minimize 15-minute no trade rule. I assume that means that you just don't trade for 15 minutes at that point. Yeah, sure. So that's fine also, as long as you're within the big picture, risk management numbers that make sense for you. Cool. Next question here was from Mark. Broad question, but what is your playbook for pre-market buying? Do you have a couple of go-to setups, or are you looking for broader moves, or both? I'm trying to improve my potential buying processes. Right now, I'm really just playing resistance and support, and daily levels is my main pre-market playbook. Sure. So it is a broad question because I do. It's not like I just do like one specific thing pre-market. So there's a few things that are going on. One is, I basically keep risk out every night. And if I'm keeping risk out overnight, it's part of a game plan. And my game plan will be telling me sometimes I need to buy or sell or add or remove at certain areas. And if my game plan says that I should be buying or selling or adding or removing at certain areas, I basically do that, and I don't care what time of the day it is. So if I have a position on that's already on, and I wake up and it's 5 o'clock in the morning, and my game plan says I'm supposed to buy stock at this price, then I buy the stock at that price. Obviously, pay attention to your spread. If the spread's too crazy, like there's, sometimes I got a couple swings on, and even though it might be like giving me a pre-market print at that price I'm supposed to buy, it's $1.50 spread, and I'm gonna wait for the market to open. But a lot of the other names, if it's an Apple or Nvidia or whatever, that's going to be a lot more liquid, I can, just kind of come in and take the buy. So that's one. Two, if it's like a newer position or a new set trade, so a lot of times what I'm doing is I'm really just taking feelers. And for me, and I know we've talked about this in the past, and this might not be right for everyone, so just, know your own account size, know what's right for you. Sometimes I can take a feeler in a position and absolutely let it bleed against me if I want to. Doesn't mean I want to lose money, but like if I have a 100 share position and it's a couple points against me and it's just this little feeler and I'm $200 against me on that's meaningless on my overall P&L on the day. So I'll do that sometimes more kind of based on a thesis. Hey, I just bought this feeler. It's just to watch. I really like my idea. I think this is what's going to happen. I don't have a strict stop loss in yet. I'm looking. Usually that's going to mean that I'm looking to size up when the market opens. But on a day like today, sometimes this morning I took a couple feelers or I took a couple ads on swings that I had based on like a game plan that I have. And I was able to do that when the stocks were red and the market was red. And by the time the market actually opened up, it was like a nice little gift that I was able to have those positions on. Or sometimes I will take real trades pre-market. So now we talked about one scenario, two scenarios, scenario three. Sometimes I will take real trades pre-market. But it's got to be liquid. It's probably got to be moving. And we've had a lot of things moving pre-market this calendar year for sure. But the other portion of it, it's got to be properly liquid. If I'm taking this trade, it's got to be properly liquid. And then the thing that's difficult about doing that pre-market with size is then the need to really babysit that trade because you can't put a stop loss in. And that has at times been a problem for me when I'm actually doing the morning meeting for the team, where it's like, all right, I'm taking this real trade here, but I can't have a stop loss in, and now I'm doing the morning meeting. There have been times where a real position, and I'm like trying not to be stressed, and I'm trying to do a proper morning meeting, blows through where I was supposed to hit out of the position, and I didn't hit out of the position because I just was doing the morning meeting and I couldn't properly focus on it, and it puts me in a really tough spot. That's happened a few times, so I got to be very careful when I'm doing that because I got to make sure that I'm able to properly hit it. And you'll see me sometimes, almost kind of pause the morning meeting, and I feel bad when I have to do that. Or I'm just like, guys, I'm sorry, I need to just manage this position or get this order in or kind of sell this position or whatever it is. So you just really got to make sure, especially if you're taking any type of size pre-market, that you know what you're doing, that the liquidity is appropriate, that it's able to move. You can get out of that position without a stop loss and know what you're doing in order to be able to do that. So certainly was a broad question. But it tends to be when I'm trading pre-market, I'm doing one of those three things if I'm executing. Cool. What else, gang? Any other questions? Otherwise, 5 o'clock on Monday. I did make a celebrity appearance at this little, what do they call that race again? Spartan race yesterday. Me and Pat, pro-death Spartan race, crushing the game. We got a little muddy, a little bit sore today, a little bit tired, but feel great. I had a good time doing it. We got a question here from Sebastian. Let's say you want to trade energy today and you see that Exxon had a good daily pattern and sure did, and Oxy doesn't. Now the reason it doesn't have it is because it's been relatively strong. That's a great question. And a leader. In this case, do you prefer to trade the stock with the setup or the leader and the strong one? It's a really good question there, Sebastian. I don't have a rule for that. I really don't. I'm going to be watching those names as they open, because you got a better setup versus having an additional layer of probability. So is the name with the better setup going to give me an intraday setup that I can get involved in? So I'm paying attention to that. At the same time, I guess the answer is I'm trying to pay attention to both at the same time and see which trade's actually materializing for me. Is ExxonMobil giving me the actual execution based on the pattern that I saw in game plan in the morning meeting, and I can just take that? Or is Oxy, which didn't maybe have that same pattern, giving me an intraday pattern that I can actually execute on, in which case I can go to it, and I want to make sure that even though it has shown relative strength on the daily chart those last couple of days or whatever, it's still actually showing that relative strength intraday to day to probably give me the setup. So yeah, no real direct answer on that for you as like the strict rule that I'm constantly following. It's probably a little bit on a case-by-case basis. Next question from Mike. Risk reward using Google as an example from this morning. If I was buying at 9:45, which one was the 9:45 trade? On the inside 5 here. Okay, cool. I was buying at 9:45 as it broke 97. Proper execution would really be 97.04 on the inside 5 break, or 97.05. Risking about 50 cents at the day low. I don't think so the day low isn't appropriate out. Yeah, you could use the day low because that's the pivot low, or you could, in this case, you could also use the inside 5 low as your stop loss. That'll help reduce your cents risk on it. How do I properly exit is the follow-up to your question. My thinking was cover risk in 97.50, perfect. And after that, I'm not really sure how to take the profits. So yeah, so 97.50 is where you would sell 50% of your position at 1-to-1. So let's assume that you're buying 97 on this break and you're giving it to lows, which is an acceptable trade. I just gave you one option for a lower risk trade, but what you're describing is an acceptable trade. You want to take 50% of your position off at 97.50. That's what I want to do to get the risk covered. And you get that right away. You get this really nice pop here as this trade's breaking up and you get your risk covered. After that, that's when you need to go into reward maximization. What is reward maximization? Reward maximization is trim and trail. And then you need to decide based on your game plan how much do you want to trim incrementally on the way up, if anything, versus how much do you want to trail. And then you need to decide from your game planning on your trailing, how much do you want to trail on different time frames. Are you going to trail everything on a 5-minute chart? If you're going to trail everything on a 5-minute chart, you're almost always going to get stopped out of your position at some point. Almost always. You will very rarely have that stock at the end of the day if you bought at the beginning of the day, because it's pretty rare that 5-minute charts are perfect throughout the day. A 15-minute chart, you have a much higher probability of still having that stock at the close. So for this trade today, let's say you took that buy versus this low, it goes, you get your risk covered, higher low, higher high, ADMA caught up, you can now raise your stop from the low of the day at 9.55 to 96.82. I know Hemming was in Google today, and I was trying to work with him a little bit on it, on how to trail, but you can raise your stop now to the 9.55 low. And then, makes it this high, it pulls back, here's your next higher low, and then you get a new high, it's in the equilibrium area. You can now raise your stop again to 97.13. Goes, gives kind of a little flag consolidation, then new highs. If you're trailing it really tight, you could have raised your stop again to these highs. New highs, new low, new high, you could then trail to here. And then bam, you're getting stopped out midday. Usually, if you're trailing on a 5-minute chart, even if you got a good-looking chart that closes on highs, or in this case, almost on highs during the day, you're getting stopped out at some point midday if you're trailing on everything on a 5-minute chart. So that's why I don't necessarily want to trail at everything on a 5-minute chart. It depends how much stock I have as well. Sometimes I say, you know what, I'm going to trail some on a 5-minute chart. I want to get stopped out on it. Let it stop me out. This was a great trade. I bought this thing at 97. I trailed it really tight. I got stopped at a stock at 97.83. Sweet, I'll take it. Who cares? But maybe you're saying to yourself, I want to really get paid for the risk that I put on. So I want to be a little bit greedier. I'm going to trail some on a 15-minute chart. So you just do the same rules on a 15-minute chart. The 15-minute chart doesn't give you anywhere to trail the entire way up until here at this time, right? So whatever you're trailing on a 15, you were keeping that original stop loss in pretty much all morning. Maybe you could trail to here or here, but it's like stretching it. But here for sure, you get a pivot, you get a new high, you can raise your stop to there. At the end of the day, you're still in the position, you're potentially swinging it, unless you trailed to here. Maybe you trailed to here on your 15-minute and you got stopped out. But that's how you want to be thinking about your kind of reward maximization on the upside, is basically how do I want to trail? Because the only way that you are ever leaving your reward truly unlimited is by having a trail. And then that's the right thing to do. You know, if you got stopped out here, that's where I want to see that you got stopped out though, Hemming. I want to see that you got stopped out at 11:35. If you got stopped out anywhere else here, you didn't trail correctly. You did not trail properly, at least not based on my rules. If you trailed Google based on my rules and you did it as tight as you possibly could on a 5-minute chart, then you get stopped at 11:35. And that's why I don't trail everything on 5-minute charts, unless I really don't like the trade. Or sometimes I will because I feel like I really can't afford to have more overall portfolio risk because I've got too many longs on already, and I welcome the stop out. I want it to go. I want to get paid as much as possible, but I'm like, you know what? You want to pull back at all and break your 5-minute stop? I'll take the money and run. I've got too much overall long risk on. I don't need this position. So I do that sometimes also. But otherwise, if the trade's kind of in a vacuum, if you will, then I almost never am trailing my entire core position on a 5-minute chart, because I'll just always get stopped out. And I want more reward for my risk. Once that risk is covered, and maybe I am trailing even some of it on a 5-minute chart, so that means I'm going to make money in this thing no matter what. Once the risk is covered, once I'm in a position where I'm going to make money in it no matter what, I generally want to be as greedy as I reasonably can be. And I do not mind giving back sometimes large amounts of profit for further upside reward. I didn't fully finish reading your question. If I move my stop to the higher low at 11, okay, that's what we were just talking about, and get stopped at 11:35, I only make... Yeah, but you don't know that. That's the point. You don't know that. At the end of the day, that's the amount of reward that the trade's risk gave you. But the game plan you had put yourself in the position to make significantly more. And that's the difference, Mike. You didn't have a game plan that said, I'm just here to make $1 for 50 cents worth of risk. You had a game plan that said, I'm going to take as much as this stock will absolutely give me, and if it just happens to only give me 2 to 1, then I'll take my 2 to 1, and that's it. But then that also then goes to what I was saying earlier about trailing on multiple time frames. You know, you weren't aiming for that 2 to 3x that you're talking about. You were aiming for significantly more. The trade just gave you 2x, and you'll take it. From Ramoon, for trimming, do you have predetermined levels to trim at? Yeah, so I'll tend to trim in kind of one of two ways, if I am at all. I still genuinely think with trend trades you're better off trailing than trimming, but I'm oftentimes doing a combination of both, especially because my tier sizes tend to be pretty sizable. So for trimming, I tend to do it either one of I guess 3 ways. I either trim because the stock reached a level for profit taking, like in the next resistance level. I trim purely based on risk-reward ratios and not about technicals at all. So I'm 5 to 1 in the money, I trim a little bit more. Or I trim because of extension. Stock just gave this massive move. It's really extended on whatever time frame I'm looking at. You know, I'm going to just take a little bit off here, and maybe I can rebuy it on a pullback and keep the difference. So those, I guess, are the 3 ways in which I'm looking at trimming. Alright, gang. Looks like we got through all the questions. Solid afternoon meeting here. It's Monday. It's October. We got through September, which was just insane. And now let's see what this market wants to give us for October. So have a great night, everybody. I'll see you all tomorrow.